U.S. trading partners are readying a response to President Trump's recent barrage of tariff threats, including a potential 30% levies against the EU and Mexico announced over the weekend. In a piece for the publication Foreign Affairs, Queens College Cambridge President Mohamed el-Erian wrote that the U.S. has, quote, shaken the very foundations of the global order, adding that there is no trusted conductor to guide countries and companies through the complicated transition to whatever's coming next. Joining me now is Mohamed el-Erian. Always a pleasure to talk to you, Mohamed, and thanks for being here, obviously, in what continues to be a very tricky time here. So I guess I would ask first whether you think we are witnessing a sort of remaking of the global order. It seems like there have been so many fits and starts. It's difficult to get that big picture.
So I think that we are no longer in a world of uber globalization, where we're looking for ever closer integration of goods and people and flows. The question is, are we in a world in which there is managed globalization light or total fragmentation? That's the question mark. And we're not going to know this for another few years, I think, Julie.
And I thought the other thing that was very interesting that you wrote in your piece is that the U.S. is almost behaving like a developing nation rather than its sort of global dominant status. What do you mean by that, and what are the implications of that?
So we're seeing market correlations that normally are more common to developing countries than the U.S. For example, the currency weakens even though yields are going up. That shouldn't happen. The negative correlations between bonds and equities has broken down. So you're starting to see things, and you're starting to hear narratives that are more common in developing countries than in the US. And I think that that's partially because the US is trying to remake its domestic system. There's a real question mark as to whether this is a Reagan moment in which the US changes things with a view to a better outcome, or is this a Jimmy Carter moment in which the US ends up in stagflation and ultimately recession?
Which do you think it is, Mohamed? Or if we don't yet know, how will we start to know?
So first, let me tell you, the market is all over the place on this. We started the year with an 80% probability that this was a Reagan moment. By the beginning of April, we were below 50%. And now we're somewhere around 70%. So we have fluctuated a lot. And that is unusual for the US with its mature institutions and big diversified economy. I think it's a 50-50. I don't think we know. I think it will depend on how other countries react as well. So it's a 50-50, but the marketplace right now seems more comfortable than I would be with where we're going.
Well, I wanted to ask you about that, because what do you make of the extreme equity resilience here in the U.S. in the face of all of this back and forth?
So I think there's two things going on. One has to do with the view that corporates aren't the sovereign, that you may have issues with the sovereign, but at the end of the day, U.S. corporates are strong, good balance sheets, good innovations. That's one view. The other view is that people ultimately think that the US is escalating to de-escalate. That what we heard over the weekend against the European Union, against Mexico, is negotiation. And come August 1st, one of two things are going to happen. Either we're going to push the deadline out yet again, or the US will get what it wants from its trading partners. So the markets are pretty relaxed about this. More relaxed than I would be, but I understand that is the trade that has worked over and over again, and you don't want to get in the way of something that's been working.
Mohamed, as we and our viewers know, you are a longtime veteran, very well-known investor. What they may not know, you've also served on a number of corporate boards. You're currently on the board of Under Armour. So I'm not going to ask you specifically about those businesses, but I am going to ask you about that experience with these corporations and how they're tackling this current moment and how challenging or not, maybe, they're finding it.
So most CEOs I know will tell you that we are in a wait and see, Julie. We're waiting to see what is going to evolve. And that's important because it impacts your supply chains. It impacts how you think of where your markets are. So whereas the financial markets seem comfortable, what we're seeing on the CEO side is postponement of major investment plans, just waiting to see. It makes a huge difference whether the tariffs are 30% or 10%. It makes a huge difference whether the tariffs are volatile or whether they're going to be fixed. So companies are doing what most people would do is, you know what, I'm not going to commit multi-year investment funding until I know what landscape I'm operating in.
So the markets, of course, about this acronym TACO, right? Trump always chickens out, that the markets seem to have adapted to some extent. But when it comes to being a corporation, you can't really, I guess, bet on that kind of acronym, right? But I mean, do you think the markets ultimately were wrong about TACO, or do we still not know how that's going to play out?
So the markets were right in saying that the deadline will be pushed back and will be pushed back again. That's correct. What we don't know is ultimately what the destination is. So the journey has been consistent with a much longer time frame than what economists were afraid of. But we still don't know what the destination is going to look like. I'm hoping that we are going towards some sort of globalization light that is managed more, that the US feel that it's trading in a fairer trading system, that it no longer is responsible for so many public goods that are really expensive. That's what I'm hoping we're going towards. But we could just as well end up in a fragmented global economy. And for companies, what you're going to hear, for example, under Trump 1.0, we went from this notion that China can be your market, China can be where you have supply chains. Do you need C+1 or C+2? One or two other countries to increase your resilience. Now you hear C plus many, and some companies don't even want the C, they just want the many. And that means rewiring your supply chains. And that's not something that you do quickly. It takes time to do so, and it is expensive.
I'm glad you brought up China, because I know there is some strategists have speculated out there that part of the reason that the market hasn't reacted more to the tariff headlines is because they haven't involved China lately, right? Most of the focus has been elsewhere, and China is the big elephant in the room, so to speak. Do you think there's any truth to that? And what do you think we need to watch for when it comes to China headline risk?
So we know from Mexico, for example, that if you're not in focus today, it doesn't mean you're not going to be in focus tomorrow. I think Mexico was surprised over the weekend to hear about the possibility of a 30% tariff. They thought they had sorted that out. So I don't think China is out of the woods. I don't think anybody is out of the woods right now until we settle this tariff issue. But there's a broader issue with China, which is how quickly will it reform its economy. China right now is no longer a locomotive of global growth. In fact, the concern, and we saw the export numbers today, the concern is that China will start dumping its exports on other markets, especially the European Union, which will cause trade tensions there. So keep China on the radar screen. You cannot ignore it right now.
Mohamed, finally, quickly, since you mentioned the EU, the bloc says it's preparing a response, but it's willing to continue to negotiate. In the meantime, there's some reports that the EU might be looking to other countries to sort of form some alliances. What do you think of that? And do you think that the EU Europe generally, the stock market has been a good investment this year. Do you think that continues as a result of their positioning?
So I think the European financial markets are benefiting from the fact that the whole world was massively overweight the US starting this year. The US had outperformed other countries consistently. The US is where the major drivers of innovations are. And the US has a fiscal policy that's quite loose. So there was reason to invest in the US. During the year, what you've had is a realization that overweight is excessive. And that's why European markets have outperformed U.S. market so much in the first quarter by 17 percentage points, Julie, 17 percentage points. I think that for the outperformance of Europe to continue, Europe has to get its act together. It's one thing that having capital pushed out of the U.S. back into Europe. What Europe really needs is to be able to pull back, attract the capital back, and it hasn't been doing enough for that as yet.
Very interesting stuff. Mohamed, always a pleasure to talk to you. Thank you so much. We really appreciate it.
Thanks for having me.